Hi everybody, hope you're all doing well. As of midday today, we will be in the second half of our lockdown, at least in South Africa. At least in Joburg, the weather's a little bit better, so I'm taking advantage of that and trying to stay out of my house a little bit and actually recording from my backyard. Unfortunately, there is quite a busy road that is behind me, so I do apologize if there's any noise coming from there. It's quite strange. The first Friday of lockdown, the road was dead quiet. Unfortunately, now 11 days in, and it's actually quite noisy. So I think it's got a lot to do with the relaxation of the lockdown and not being as strict. But I think a lot of people actually aren't adhering to this lockdown, unfortunately, which could cause problems for us all going forward. But yeah, so I thought I'd obviously send this through for you, just a little bit of an update on coronavirus and what's happening. Obviously, I'm sure you would have heard about us being downgraded by Moody's to junk status, and then also Finch, who further downgraded us another notch, which also affected obviously our markets. And obviously, we're now seeing bonds selling out of our markets. But I'll try to keep this as short and sweet as possible. And please, again, if you've got any questions, queries regarding it, please let me know. I'll be more than happy to answer any questions or queries. Yeah, so if we obviously take a look at the coronavirus update as of close of business yesterday, the 5th of April 2020, there were 56,873 tests that were actually done. Obviously, the cases that have come about of that is 1,655 confirmed cases and 11 deaths so far. Which is still relatively low. What does concern me with this is I know the health minister has obviously rolled out 60 testing vehicles that will do on-site tests so that they can obviously get to the more populated regions. As far as I'm aware, there's less than 10% of those vehicles that are actually ready and actually are working out and about. Last I knew it was only 5 vehicles, but there could have been more that have been launched now. My worry is as the number of tests get done, that we're going to see a higher percentage coming through. The percentage of infected people is currently sitting at somewhere around about 3%, so it is a very low percentage. If it stays there, it means, you know, we could have up to 1.5 million cases, not at any one given time, but in total of people affected. So yeah, we'll have to see what that happens. I do think the South African government has been very good in reacting to the whole coronavirus outbreak, but I do think it's a little early for them to have relaxed a lot of the lockdown and all the restrictions for some people. But yeah, I'm still positive. Unfortunately, we've seen Donald Trump, who has urged his people to be wearing face masks and protective gear. Unfortunately, he himself has come out as saying he's not going to be wearing any face masks, which goes completely against, you know, what a leader should be doing. It's a matter of leading from the front. So if he's saying he's not going to do it, why does his people need to do it? And the worry is that the US has become the epicenter of this pandemic. And you know the old saying, when America sneezes, the rest of the world catches a cold. So it obviously is a very big worry for us as an emerging market and as a world in union, so to speak, as well. America needs to be taking a serious stance against it. What is interesting to look at is obviously the US initial jobless claims. So people who are actually claiming for financial support, you can see that number has been extremely low over the years. And I mean, this is pre-1970. And you can see all of a sudden the 21st of March, it jumped up to 3,307,000 people who actually applied for financial assistance, and just 1 week later that number more than doubled to 6,648 6,648,000 people that are now applying for assistance. And that means those are people who don't have jobs. As we know, in America, it's very different to here in South Africa, where once you've got a job, there's certain processes that have to be followed. We have unions in South Africa. So it's very difficult for people to lose their jobs. And even if people get retrenched, it means that the company cannot replace those people for a certain amount of time. So you can't just go retrenching people. Whereas in America, if obviously the economy takes a downturn, profits are down, the companies can simply just actually lay off people. Sorry, you have a job today, you don't have a job tomorrow. So that is affecting it very badly. Obviously, Trump wants to try and make sure that he gets his economy up and running again. He wants to bring the number of unemployed back down, because this is going to affect his re-election. Hence, I think he's even considering looking to lift all restrictions in America to try and just get their economy turning over again as it was pre-coronavirus. I think something that's very important, and I've gotten a lot of queries about it, is insurance to cover people who are affected by coronavirus. And one thing that can be of assistance is long-term insurance, is temporary income replacement. So if you're unable to work, and if you get the coronavirus, you will be unable to work, unfortunately. But it is very important to remember, if you have temporary income replacement, it usually comes with a waiting period. The waiting period is usually 1 month before you can claim. And chances are good, if you've had contracted the coronavirus, you definitely will be unable to work. But after that 1 month waiting period, you will be able to claim against your temporary income replacement, but only for a period that you are, after that 1 month, unable to work. So that is obviously an option available to you should you contract the coronavirus, which we hope that doesn't happen. Obviously, if you haven't contracted the coronavirus, we are in this lockdown situation, and for some reason you are not getting paid, or if you're a business owner and you are not receiving revenue and therefore also on paying yourself dividends, if you have any sort of debt outstanding, you should speak to those service providers to find out if you do have credit insurance with that debt. If you do, that credit insurance should be able to pay your debt, the installments of your debt, for up to 12 months. So something very, very important to take a look at. But you will obviously have to prove that you are not receiving an income at the time. If you are a business owner, hopefully with your short-term insurance, you could possibly have revenue insurance. So if you're unable to earn revenue from your business, could possibly have insurance that could pay revenue or pay monies into your business in order to keep your business afloat, make sure your employees are paid up until such time where it's business as usual again. But I would recommend you do speak to your short-term insurer regarding that. Obviously, we've heard a lot of banks coming out saying also they are going to be offering payment holidays. Payment holiday, if you are not receiving an income or revenue from your business to be able to receive dividends from your business, obviously would be a very good thing, because if you can't afford to pay for your debt, and you can take up to a 3-month payment holiday, it will obviously protect your credit rating, and it'll ensure it keeps you afloat over that time period as well. However, if you are receiving income over that time period, it is not recommended that you take a payment holiday, because even though you won't need to make that payment, it's not a matter that the payment is going to be made for you. It is still going to attract interest, and it is just purely going to be rolled over and put onto the end of the payment term, which means you're going to pay far more interest over that time period. You know, we're always talking about the importance of an emergency fund, and this is one thing where it's really come to the forefront, is how important it is to have an emergency fund where you can access a number of months worth of income from savings, just to get you through these difficult times. And I mean, we wouldn't have experienced anything like this in our lifetime, and it's usually a matter of if you have unexpected expenses or for some reason you do lose your job. But now when people might not be earning an income now, and purely because of the lockdown, if you had an emergency fund that you could pull funds from, obviously it would be business as usual for you. Therefore, it is very important to have at least 3 months worth of income stored in an emergency fund, some sort of a money market type fund where it's still earning a decent interest rate. And if you don't have something from the bank, obviously we do it through our Investec corporate cash manager, and we can assist you where it does achieve preferential interest rates. So very important to look at that going forward. And then besides having the COVID-19, the coronavirus, obviously having the oil wars between Russia and Saudi Arabia, as I've spoken about. Here we have junk status I mentioned earlier. Now that Moody's has downgraded us, Finch has downgraded us further. So we, strictly speaking, are non-investment grade at this point in time. Obviously, we know that can be turned around. We can become investment grade again, but we have to obviously turn things around. We have to show growth in our economy. We have to make sure that we're implementing processes, not just talking about them, and it's going to take time. Obviously, the key drivers for Moody's downgrading us were a number of different things. You know, it's the economic growth. Although our growth was very low, we know also with the coronavirus we're going to have a negative growth. We're going to go into a recession this year. That's pretty much a foregone conclusion. You know, our electricity supply is very inconsistent, very unreliable. So people don't want to invest into our country. Therefore, there's very weak business confidence. You know, government's capacity to limit the deterioration, we don't have much ability to limit it and to help the economy. There's no progress on our structural economic reforms. There's a lot of talk about it, but there's nothing implemented. And then obviously we have the fiscal deficit, which is expected to widen, and our huge public sector wage bill, which directly impacts that as well. We know President Ramaphosa is trying to reduce our public sector wage bill, although I think that's going to be very difficult to do now that we're going to see an increase of unemployment, largely due to the coronavirus, as well as the actual downgrade in our economy to junk status. As much as they want to say it's a technical recession, unfortunately it's not. It's going to be a proper recession. We see, as say, for this year, negative growth, probably somewhere around about 3.5% to 4% for this year. So that's a contraction in our actual economy. And then next year, we're probably looking, they're estimating probably growth of only about 1.5 to 1.7%, which means it's going to take a number of years to get back to where we were pre-coronavirus and pre-junk status. So it is a very bitter pill to swallow. Although when we take a look at a couple of things, if you look at this slide, this doesn't show what our rand is on compared to the US dollar, but it's just showing the weakening of the rand compared to the US dollar from the 1st of January to the 30th of March compared with other countries, especially emerging markets. And you can see Russia on the 30th of March had a higher weakening percentage than what we had. Mexico and Brazil were very, very close to us. Obviously, we've seen since the 30th of March and the downgrade, we've seen further weakening in our currency. So we'll probably be at the top of that table at this point in time. But it just shows you that it's not only South Africa that have lost value in the rand, but the other emerging markets are battling as well. Important to obviously take a look over this period. What have our portfolios done? So I've pretty much called it the downs and the ups of 2020 so far. And if we take a look at what our portfolios and how they've actually performed since the 1st of January up until the 23rd of March, which was at this point in time the bottom of this bear market, you can see that the JSE has done negative 32.96%. And please bear in mind, these figures are based in South African rands. Therefore, you'll see the MSCI World Index only shows a weakening of, or a negative return of 13.48%. Reason is the weakening in the South African rand is included in that world index reading, so it doesn't look as bad, but in actual fact, the global markets also contracted by in excess of 30%. What is important to see over here is you can see all of our different portfolios that we have locally and globally. We're not affected nearly as badly, and they actually fared very well compared to what the other markets or the actual JSE actually did do. And if we take a look then from the 24th of March to the 4th of April, where there has been some recovery coming through already, we can actually see over there that the portfolios have provided double-digit returns in most cases, especially your high equities, because we've seen a very big rebound on the JSE, and we've also seen a very big rebound on the MSCI World Index as well. Then with the weakening rand, obviously that has helped our portfolios, as we do have offshore exposure in all of our portfolios, which is extremely important to protect against the weakening rand. As we know, the weakening rand unfortunately will continue in the long term, as we are an emerging market, and on average the rand weakens by 6 to 6.5% per annum over the long term against the US dollar. But as I say, if we take a look at this, and you would actually see, if we had to do a graph from the 1st of January up until the 4th of April, which unfortunately I don't have here, you will especially see the funds like the global equity portfolio, because of the weakening rand and because of the recovery that we've seen over the short term already, actually has still had a positive return over the 1 year period, meaning that investors invested in the Resolute Wealth Management global portfolio wouldn't have actually been affected negatively, but their returns would have probably been relatively flat. But hopefully we'll see the returns continue and trending upwards over the medium term as our markets continue to recover, pushing the percentages achieved up again. You know, obviously, in conclusion, the global GDP will record a decline in 2020. Even if we see a V-shaped recovery in the second half of 2020, I think we're going to see a recession in most markets. The US and the European countries have been able to implement significant monetary and physical backstops. And fortunately, as South Africa, we don't have those reserves in order to create that backstop as much as we would like to, or Ramaphosa will try. Yes, they're going to throw everything they can at stopping the coronavirus from spreading, but unfortunately when it comes to putting money into the economy, South Africa is very limited in what we can do. Unemployment is expected to rise fairly sharply, again because of the coronavirus, again because of downgrade to junk status, and it's going to be very difficult considering we already have a very high unemployment rate. So obviously we'll be watching those numbers just to see what happens there. You know, obviously if there is a snapback, so a quick recovery in the second half of 2020, we must assume that the virus-related restrictions are substantially reduced by mid-2020. At this point in time, you know, we see if South Africa does come out of lockdown, I think we are still going to see a lot of restrictions in place, which is going to hamper the growth of the economy even in the second half of the year, which is a worry, and especially again, you know, as I talk about how busy our roads are behind me over here, how we see out and about, there are a lot of people moving around. I think we're going to battle to keep this virus under control. We need to all obviously play our part. The lower oil price, subdued wages and recessionary economic conditions will push inflation lower. However, we have seen in oil going up to $33, $34 a barrel, which is going to push our inflation back up again. It'll still be within within the levels we need it to be, but it's obviously not going to assist with keeping costs down. You know, there's a serious risk of resurgence of infections. We may even see China coming back and infections getting out of control, where they might have to go into a secondary lockdown. We could see in South Africa, if we come out of this lockdown and not enough has been done, or not enough restrictions are kept in place, we could see us having to go into a second lockdown. So obviously it is, again, something that is going to lead to higher unemployment and physical deterioration. You know, there's two critical risks that are also a major concern the longer the global shutdown lasts. It's deep-seated credit crisis in emerging markets that even the IMF struggles to combat, and the second is widespread social unrest. And if we take a look at it, the US is a worry. Peak virus cases only expected mid to late April 2020. Global monetary policy is maximum stimulus. All in, global fiscal policy still needs to partially mitigate the profit crisis coming. South African equity valuations are very attractive on medium-term view, but we need a global recovery to come through. SA bond yields offering at very attractive investment opportunities despite the downgrade. I mean, the yields were sitting at just over 11% on a 10-year bond during the course of last week. Therefore, does provide very good returns for clients who are invested in bonds. And then obviously, cash is king. I think we're going to see a lot of fund managers maintaining high levels of liquidity. One of the main reasons would be obviously so that they can actually make use of that cash and put it into equities as the opportunities present themselves. So obviously something that we'll see as a trend through all of the fund managers. So what obviously happens now that we are junk status? Our government bonds become non-investment grade. Although there will be a sellout by investors who are only allowed to invest in investment grade bonds, our bonds will now become available to a new range of investor base. So we think that might be a short-lived shock that we are going to see in the to especially the currency. There has been a delayed reaction because obviously the bonds only have to be sold out by the end of April. People started selling our bonds during the course of last week, hence we saw the spike in the currency, and we're still seeing the spike in the currency. Although today it's sitting just under 19, it's come down to just under 19. We could very possibly in the next couple of days be over 20 rand to the US dollar. It is going to lead to things being more expensive. Us as South Africans, it'll cost us more to borrow money, which ultimately will affect us as individuals. It's going to result in increased inflation and result in increase in day-to-day living. Obviously, as we see also, as our currency weakens, we're going to see the price of oil rise. As the price of oil rises, it means people have to pay more for petrol, suppliers charge more for their individual goods, and it costs us more to buy stock off the shelves. So yeah, unfortunately it does have a very big knock-on effect. But that being said, it's not all bad. The downgrade to junk status has been delayed by Moody's since 2017, 2018, and although it's not good for us to go into junk status, you know, we don't have to carry on trying to impress Moody's or S&P or Fitch to try and keep us on investment grade anymore. We can rather now, Ramaphosa can at least concentrate on rebuilding, growing our economy, and actually doing what's best for us as South Africans. The coronavirus pandemic will definitely, or at least should, overshadow the downgrade, which is likely to mute many of the effects of the downgrade, allowing us time to adjust. And I think that was had a lot to do with Moody's decision to carry on with the downgrade and not to hold off on the downgrade. And I think in the long run, it's going to be a very good thing. The downgrade was very much priced into the markets. Therefore, we've seen relatively muted effect on the JSE. You know, today again, the JSE was up by just over 2% at midday. you know, but as I mentioned, we've seen a weakening of the rand due to the sellout of our bonds. But then again, we haven't seen the other sectors who can now buy our bonds buying into our bonds as yet. So obviously, it'll be interesting to see what happens with that. Obviously, due to the coronavirus, the way the markets have been reacting, and obviously due to the downgrade, there are a couple of changes we are going to be making within our portfolios. There are two main changes where we are going to be removing the Fairtree Flexible Income Fund from our portfolios, which is very much in our more conservative type portfolios. This is due to the credit risk, and unfortunately Fairtree Flexible Income Fund has a very high exposure to credit risk. The credit risk has actually been put on hold at this point in time, therefore it doesn't look that bad, and that's why we actually want to move out of the credit risk before they actually re-rate the credit risk, because that could very, very negatively affect obviously our portfolios. So that is one thing we're already busy with. And obviously the outlook for local property has been dismal over the past 18 months to 2 years, and unfortunately we're seeing no improvement in it. And especially now with the lockdown, we're seeing a huge number of tenants, Edcon included, Pepco, who are saying, well, they're just not going to be paying their rent because they cannot afford to pay their rent, which means landlords are going to suffer, which means therefore property is going to suffer and property funds are going to suffer. So although we've got a very low weighting to property at 5%, we've decided, unfortunately, at this point in time, we're going to rather remove that full 5%, and we'd rather redirect that weighting into local and global equities, where there are renewed opportunities due to the bear market and the drawdown we had in markets. But yeah, otherwise, you know, that really is my story. I think we do have some very, very good opportunities coming through. As I say, you know, we are looking to allocate more funds away from property and going into local and global equity. You as our clients, you'll know we've always got offshore exposure in our portfolios. Therefore, the weakening rand has actually benefited us over this period. But yeah, it really has created opportunities going forward, because we are very, very mindful, obviously, that we could see a lot more volatility coming through within our local and global markets. And the longer the coronavirus pandemic is an issue, the more of a headache it's going to, I think, create for all investors. But as I said before in my previous recording, all of the indicators do reflect that we have seen the bottom of this bear market. Although the recovery might not be instant, but it could be over the next couple of months, over the medium to longer term. It does create an opportunity for investors to obviously buy in at the bottom of the market and obviously take part in that correction within the markets of that 20-30%. As I pointed out in my earlier slide, we've already seen a fair amount of correction coming through. Obviously, the weakening of the rand has helped the portfolios as well, and therefore we're still obviously very happy with where we sit at this point in time. Obviously, we are being active and making changes to our portfolios as they are necessary, as I mentioned, with the Fairtree Flexible Income Fund, as well as moving out of the Sesfikile Property Fund. But yeah, otherwise we feel it is still business as usual. We will carry on making sure we do what's best for our clients and our clients' investment, and we'll obviously keep you updated on what is happening. But please, again, if you have any questions, any queries, any concerns, you know, email me. We can Zoom chat, talk over the telephone. Hopefully in a week and a bit we're out of this lockdown, and we'll hopefully start getting back to a bit of normality, and we can carry on with our lives, or at least we hope so. But otherwise, for the time being, keep safe, keep well, and we'll chat soon.